Okay, in this video we're going to be looking at some of the weaknesses of monetary policy. So why can it be less effective in trying to achieve domestic economic stability? The first reason is referred to as monetary policy is a blunt instrument. What that means is that monetary policy is ineffective at targeting specific areas of the economy like budgetary policy. The RBA can't say, all right, we're going to try and increase employment amongst the youth, or we're going to try and improve living standards for those in the manufacturing industry. It can't promote equity, it can't promote growth in particular sectors, and it can't solve the problems with a two-speed economy. And the reason for that is that all they can do is change the cash rate, which will flow on to other interest rates in the economy. So if we have one side of the economy that's growing really fast and the other one is growing really slow, we can't give subsidies or assistance to the one that's growing really slow. All they can do is increase or decrease interest rates. So if we have a two-sector economy, on the West Coast we're growing really strong, they might want to increase interest rates to try and slow spending, while on the East Coast we would need to decrease interest rates to try and stimulate spending. So if we decided to increase interest rates, that might be good at controlling inflation on the West, but it's going to make those on the East suffer because they've got lower discretionary incomes and they're already suffering. So during the mining boom, for example, the East Coast was suffering from a high dollar, but because overall growth was too strong, if the RBA decided to increase interest rates, that would just further hurt those on the East Coast. So they can't target particular sectors of the economy. It's ineffective at solving some of the problems with the two-speed economy, and they also can't target living standards specifically or address market failures. All they really can do is they can stimulate or slow down aggregate demand at a macro level. They can't target particular sectors of the economy. Another problem is they have really long impact lags. While the implementation lag to actually change the cash rate is quite quick, it can take a long time from when the cash rate changes to have its full impact on the economy. So what I mean by that is it can take a long time from the cash rate being changed to mortgages changing and then that impacting people's borrowing and lending in the economy. So because it takes so long for it to have its impact, up to 2 years after we change the cash rate, the RBA needs to be really preemptive. And what I mean by that is they need to anticipate what's going to happen with inflation and be very forward-looking to see whether inflation is likely to emerge in the future. The problem with this is because they have to be so forward-looking, they can make mistakes. So they can be pro-cyclical with their behaviour, which basically means, we might be in a trough and therefore they lower interest rates. But by the time the interest rates have their full effect, we may be in a peak or growth must be relatively strong. So that can cause even more inflationary problems. They might tighten monetary policy because we are in a peak and then something unforeseen happens like the GFC, and then by the time interest rates have their effect, the economy is growing quite slow and we've tightened monetary policy, which can lead to an even bigger trough or a recession. So the weakness of monetary policy is it has a long impact lag before it has its full effect on the economy. They also don't have any direct control over interest rates. So all they can do is manipulate the target cash rate and then manipulate the cash rate by buying and selling securities. They don't actually have the power physically to change the interest rates we pay on mortgages and credit cards. And that's dependent on the competitive pressures in the market. So it's often that the rate cuts will not be passed on. The banks may just simply use the interest rate cuts or the cash rate cut to improve their profit margins. There's nothing forcing the banks to pass on a cut in the cash rate. And at the moment, they're not passing on the full rate cuts because of their higher funding costs. That's making monetary policy less effective. So another weakness, so it's a blunt instrument, long impact lags, and they don't have any direct control over interest rates. Another one is they're becoming less effective during an economic downturn. We've talked about this a bit in class, but particularly during troughs when they try and lower interest rates, we want to boost spending, we want to boost people's discretionary incomes. But the fact is at the moment, people are just using the extra money to deleverage. People are using the extra money to pay off their loans. They're not actually spending any more money in the economy. So the RBA, because of this deleveraging effect, the RBA has to be even more expansionary. They have to cut the cash rate even further if they want to have their desired impact on economic growth and economic activity. So because people are becoming more reluctant to go into debt, the RBA has to be even more expansionary in their approach to monetary policy going forward. People are also being reluctant to going into more debt. So even if interest rates are low, they're in so much debt that people aren't borrowing so much. That should say low, not high. Sorry. Monetary policy is also not very effective at reducing cost push inflation. So a tightening of monetary policy can be really good for reducing demand pull inflation, but that's actually going to lead to more cost push inflation because those firms with existing variable rate loans will now be experiencing higher production costs. So that can actually hurt their ability to pay off their loans and hurt their production costs and lead to some cost push inflation. So monetary policy is used to reduce demand pull inflation, but it can't do much for cost push inflation. Another weakness is monetary policy may conflict with other policies. So, for example, when we're in a trough and both monetary and budgetary policy are being used in an expansionary fashion with big budget deficits and a low cash rate, the problem is the high budget deficits can lead to crowding out. So it can lead to problems because the high budget deficits can lead to the bank having to borrow from the private sector, which can lead to higher interest rates. So that can conflict with monetary policy trying to be expansionary. Common question you might get in this year's study guide is about evaluating the strengths and weaknesses of budgetary versus monetary policy. So, for example, how might they both work during a trough in order to stimulate aggregate demand? So explain with relation to the strengths and weaknesses of both monetary and budgetary policy, which would be more effective in stimulating aggregate demand in a trough. So now you've got to apply all your knowledge of the strengths and weaknesses of both policies and articulate how they might be used effectively to get us out of a trough. So for example, monetary policy, the manipulation of the cash rate, and budgetary policy, the government's revenues and expenses, have both strengths and weaknesses in terms of stimulating growth during a trough. Looking first at budgetary policy, why is budgetary policy more appropriate? Well, for example, if aggregate demand is weak in particular sectors of the economy, budgetary policy will be more effective. They're able to target particular sectors. If youth unemployment rates are higher, then they can do things like the Youth Jobs Path program. If there's high unemployment in the manufacturing, they may give subsidies or other forms of assistance to help in those industries. So budgetary policy is a lot better at targeting particular sectors, where monetary policy is a blunt instrument. It only has the capacity to stimulate growth as a whole. It can't target particular sectors. So it may be less effective if we're experiencing a two-speed economy because they can't just change interest rates for particular sectors. Another advantage of budgetary policy is it has a short impact lag. So when we lower taxes or when we implement infrastructure projects, they have an immediate impact on economic growth once they're implemented through through consumption and G2 spending. Monetary policy, on the other hand, has a long impact lag. From the time that we change the cash rate, it can take up to 2 years before interest rates can flow through and then impact on consumer spending. So that's another benefit of budgetary policy over monetary policy. Other problems with monetary policy that are making them less effective: the banks aren't passing on the rate cuts. Most borrowers are just deleveraging with the extra discretionary income. So that, there again, weaknesses of monetary policy and why budgetary policy may be more effective during a trough, because the banks might not pass on the rate cuts and the people are deleveraging anyway, which is making them less effective. Having said that, despite the weaknesses in terms of being a blunt instrument, the impact lag, and the fact that banks aren't passing on the rate cuts, monetary policy does have some advantages. So that might include the fact that the implementation lag is really short. So once the RBA decide they're going to change the cash rate, the RBA will move quickly into the money market to ensure that the cash rate comes close to the target. So they don't have to worry about implementation lags from passing through the Senate or anything like that. Once the RBA announce they're going to change it, they can act quite quickly to change the cash rate. And even the governor suggesting they're going to decrease the cash rate can boost aggregate demand without them actually having to physically do anything. Budgetary policy is also not subject to political constraints, and they're not suffering from this idea like budgetary policy where they have a lack of funds. So like budgetary policy is focusing on fiscal consolidation, which is making it hard at the moment for them to be expansionary and boost aggregate demand. Whereas monetary policy doesn't have any problems with debt or anything like that, so they can afford to be more expansionary at the moment. It's a really key thing that shows your knowledge of what's happening at with the policies at the moment. Another potential weakness, you could analyse the two of them together. So a potential weakness may be that an expansionary budget deficit may conflict with an expansionary monetary policy because it may lead to some crowding out because of the higher interest rates. And in summary, both budgetary and monetary policy have their strengths and weaknesses in stimulating aggregate demand. Arguments could be made that monetary policy is more effective in slowing growth in a boom than increasing demand in a trough. However, they can both be utilised to increase economic activity during a trough. You could say potentially budgetary policy is more effective, but that's a matter of opinion because that also has its constraints. Thank you.